Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, June 16th, 2021, and I'm pre recording this Trading Places Live for Thursday, June 17th. Futures currently are down after hours action. Last look, the Dow Jones futures down 75 points, the S&P 500 futures down about 12 points, and NASDAQ futures down a bit more on a percentage basis, down 52 points. This comes on the heels of the latest Fed policy statement, which was out at 2 o'clock on Wednesday afternoon. We're going to talk quite a bit about that. In fact, let me go ahead and excuse me. Let me go ahead and jump into our agenda for today. We are going to start off with, of course, the daily market recap. Then we'll get into talking technically. Got a few ratios to show you, and I want to point out what happened after 2 o'clock today, which I think is going to be kind of the theme for this entire show today. The Fed reaction. We're going to have a number of different sectors and industry groups that I want to run you through. Take a look at some of these charts and how the initial reaction played out to the Fed's announcement today. Then we'll get into earnings reaction and wrap up with the three you must see, as we always do. Before we get into any of that, let me take you over to earningsbeats.com, where if you're not currently a member of our community, we'd love to have you. It's a free newsletter that we offer. It is published Mondays, Wednesdays, and Fridays. All you need to do is type in your name, email address, hit that subscribe button. We'll make sure we get it out to you. There's no credit card required. It's completely free, and you may unsubscribe at any time. Moving on to the action on Wednesday. Dow Jones Industrial Average down 265 points, closing below its 50-day moving average for the first time in several months here. The S&P 500, not that dramatic, but we did see a move down about 23 points. Intraday, we went below the 20-day moving average, but we did manage to hold on there. NASDAQ, on a relative basis, the NASDAQ actually did better. And this was after the Fed acknowledged that inflation was heating up. But some of the trades didn't really, or some of the way the market responded and reacted to the announcement, you wouldn't really been thinking that the market was concerned about inflation. And we'll talk about that some more. But the NASDAQ on a relative basis actually outperformed both the Dow and the S&P today. Mid caps down 2/3 of 1%, 17, almost 18 points, and small caps down just a fraction, less than 1 point. So small caps held up the best on a relative basis. Looking at the sectors, discretionary stocks were the best performers. Now, this has been a group that hasn't been very strong, and we have to remember it is option expiration week. So it's not all about the Fed. It's not all about inflation or lack of inflation, or there's going to be inflation or there's not going to be inflation. I can tell you the one thing there is going to be, and that's option expiration on Friday. And anytime we get into option expiration week, we have to start looking at some of the weaker areas for bounces and some of the stronger areas for weakness. And on Wednesday, discretionary stocks, the only area to finish in positive territory. That doesn't sound inflationary. This is not the group you would think would be leading after a big bout of inflationary news, or at least the Fed's reaction to the inflationary news recently. Anyhow, financials also came storming back. That candle may not look that impressive, but when I show you what happened after 2 o'clock today, I think you may have a little different impression of how financials performed today. Utilities, the worst performer, down 1.5% today. Then there were staples down 1.33%, and materials dropped another 1.11%. Look at this breakdown below the 50-day moving average. Talked about this recently. I would be watching maybe around that 82 area. I think it was on the weekly chart that I showed, the 20-week EMA, which would be tested somewhere around 82, 83 on the XLB. So I'd be looking for that. But overall, I would say that the market reaction, for the most part, was negative after the Fed came out. We had an initial push to the downside in most areas. We rallied back, and then we finished a little weak into the close. And as I said at the top of the show, we do have futures after hours pointing lower. We'll see whether or not that sticks. And that would kind of coincide and support what we're seeing in terms of options, both the spider and the QQQ. In my opinion, based on options expiration and based on max pain, I think both of them could have directional moves to the downside. That's what we talked about at our max pain session on Tuesday evening, and I would continue to look for that. All right, let's move on to the 10-year Treasury yield. First, economic news out on Thursday morning. Look for the initial jobless claims. Last week, 376,000. We're looking for that to drop to 360,000. Then we've got May, Philadelphia Fed Manufacturing Index. May was 31.5. We're looking for that to drop slightly to 31 for June. Actually, I think that's the May report. So I think that previous one was April, but I'd have to check on those months. But anyhow, we are getting the Philadelphia Fed Manufacturing Index out on Thursday morning. May leading indicators are expected out also, and they're expected to rise 1.3%. April rose 1.6%. So still looking for further strength there in leading economic indicators. 10-year Treasury yield, looking at the action on Wednesday, big move to the upside. And if we pull this up on a 10-minute, 5-day chart, look at what happened after 2 o'clock. Bond market closes at 3 o'clock, so we only had 1 hour. But that was a huge move to the upside in the 10-year Treasury yield. So the Fed essentially came out, and I think it was in their last meeting, which was back in the end of April, they indicated that they were not expecting any interest rate raises until 2024. Well, I would say one of the bigger changes in the policy statement that was delivered this afternoon was the fact that the Fed is now looking at possibly raising once at the end of 2023. So they're moving it up a little bit when they're planning to raise rates. There was no immediate change to anything, so, and no one was expecting that. But recently it's been about the language, and I just wanted to point out that the Fed is now looking to raise a little bit earlier, but they stuck to their guns in terms of saying that they believe inflation is transitory. They recognize that it's hotter than expected, but they still believe that this is going to be temporary. And if they are correct, then I think long term we will still keep fairly low interest rates. The economic growth, I think, will continue. And I think that's going to be a recipe for higher prices for stocks. So I'm still sticking with my forecast. I'm still very bullish on the market. Short term, anything goes. We're in the summertime. We have to be ready and expect the unexpected. But I think longer term, I still believe the big picture is that we're going higher. And whether or not it's higher each month for the rest of the year, or whether we consolidate and maybe even sell off for a bit during the summer and then rally in the fall, it's hard to say exactly how it's going to play out, but I do believe we go higher, and I think we're going a lot higher. All right, moving on, let's talk a little bit about talking technically. So here's the IWF IWD chart. And you can see today, it was basically unchanged. So you might think there really wasn't much going on. I would just say, you have to look a little bit beyond just the one daily, because that's just a line that connects yesterday's close to today's close. So how about we break it down to a 10-minute chart, and let's look at the last 5 days on this ratio and just look at what happened in the last 2 hours today. So let's get this chart up. All right, here we go. So in just the last couple of hours, you can see the initial reaction when the Fed started talking about raising rates earlier than expected. You can see that immediate impact on growth stocks. Growth stocks underperformed immediately, but then they rallied back in the last hour and a half. Not exactly unchanged from prior to the announcement, but we did get a lot of that back, which I thought was very important. And we'll see what happens from here on out. This is just a 2-hour reaction. We don't know everything that's going to take place in the market based on 2 hours, but it does give us the first clue. And clearly, the market's initial reaction, which sometimes can be a knee-jerk reaction, that initial reaction was to sell growth stocks. But that did change as I mentioned in the last 90 minutes of the session. All right. Another key index that I like to follow, ratio that I like to follow is the XLY versus the XLP. This is consumer discretionary versus consumer staple stocks. Well, if inflation is going to be a problem and if the market's going to take a hit, probably the last thing you would expect is for consumer discretionary stocks to outperform consumer staple stocks. But that's exactly what happened. In fact, after a very quick initial reaction to the downside, consumer discretionary blew consumer staples out of the water in the last 2 hours. That doesn't look like what I would have expected if the market was concerned about inflation. So this is something that you need to at least scratch your head and wonder, okay, what's going on here? How about transports versus utilities? If we look at this, look at what happened here in the last 2 hours. Once again, if we're thinking there's going to be inflation, we think that there's going to be, problems in the market ahead, you would think transports would underperform and utilities would outperform, but that was the opposite. Last 2 hours, we actually saw money rotating into transports relative to utilities. So another sign that we have to at least scratch our head and say, this inflation story maybe isn't making a whole lot of sense. The final thing I want to show you here is the huge rally in the dollar in the final 2 hours. Look at this move in the dollar. So after going sideways for 3 or 4 days between 24.32 and 24.37, literally in 2 hours, we jumped up to 24.55. And once again, if you think that there's going to be an inflation problem, that eats into the value of the dollar. The dollar index should not have been moving higher. So a lot of what I was taking out of this report and the market's reaction to the report is that the stock market believes the Fed. The stock market believes, yes, we have inflation. Yes, it was hotter than expected, but no, it's not here to stay. This is going to be a transitory inflation problem. And that's the way the market seems to be reacting to me. Now, I will continue, and I'm going to show you some numbers here in just a minute and some charts. But I'll continue to monitor how the market evolves from here over the next week, the next few weeks, all the way until we get the next PPI and CPI reports, which will be out next month. But for now, I think we have to go on what we're seeing. And what we're seeing in the very near term is that the market is really shrugging off inflation. And I think that's the right call, but we'll continue to monitor it. All right, so let's move on to the Fed reaction and talk a little bit about the sectors and the industry groups that benefited or that were hurt by this announcement that came out. I can tell you without a doubt, the most positive reaction after 2 o'clock was in the financial area. And that makes sense. I mean, we saw the 10-year Treasury yield spike. Well, that tends to benefit financials, especially if the spike is not due to inflation. And as I was pointing out, I don't believe that the market is, I don't think that we saw the 10-year Treasury yield moving up because of inflation or because the Fed is talking about fighting inflation. I think it's moving up because the Fed decided that, hey, we may be raising rates at the end of next year, possibly to ward off inflation long term. But I think it's also because the economic activity that we're expecting over the next couple of years. I think we're going to get to a point where it's time. We don't want the economy to overheat, and so I think that whole idea of moving those interest rate increases up, even if just slightly. I mean, we're talking the end of 2023. It's 2021 right now. We're talking about maybe not for more than 2 years, 2.5 years before we see a rate increase. So there's no urgency, or there certainly seems to be no urgency on the part of the Fed to think about raising rates anytime soon as a result of inflation. And I think all of that was taken into account in this market reaction that we saw in the last 2 hours. So the financials, when you look at this daily chart, doesn't really look like much, but I want to show you the 10-minute 5-day chart. And this was 2 o'clock. You can see financials were at a 5-day low. Things didn't look very good. And in the manner of 60, 70 minutes, we had not only moved up, but we had moved to about a 3-day high on the XLF. So we had a quick turnaround, and leading the charge on the financial side, we had banks. Let's pull some of these up. So here's the banks. There's the banks reaction. Very strong move back to the upside. How about investment services? Investment services, look at that move. Initial move went down very briefly, and then a quick pop back to the upside. And investment services moved to almost a 5-day high by the end of the day. So pretty solid reaction there. Also, asset managers having a very strong reaction. Here you can see big move up, continued that move, and we weakened a little bit into the close. But I think it's pretty clear many of the financial areas were doing very well. How about life insurance? Another area within the financials. Nice reaction back to the upside. How about full line insurance? Another financial area. Look at that move to the upside. So it was clear financials, many of the areas of the financials did extremely well. Now, outside of financials, some of the areas that did the best were recreational services, the DJUSRQ. And you can see here, initial move was down, but then we rallied into the close, finishing near the high of the day. Gambling stocks made a nice move. Initial move was down, but then we rallied back up. Hotel REITs, for the most part, real estate was incredibly weak. And I'll talk about that more in a minute. But the hotel and lodging REITs, after an initial push to the downside, actually strengthened nicely into the close. So this was the one area within the real estate area that did pretty well. Transportation services also finished pretty strong in the final couple hours. Initial move was down, but then we rallied and actually finished above where we were when the announcement was made. Before I go any further, let me pull up the S&P 500 so you can see what the S&P 500 did. Here's where we were. We took this big drop, rallied back, and then finished lower. So you can see where we had finished below where we were at 2 o'clock. So the net in the last 2 hours was actually down on the S&P 500. If we pull up the NASDAQ, you'll see basically the same thing. Moved down, a rally back, it went positive, and then closed weak again and was down net over the final 2 hours. So I wanted to kind of give you that just so you can have that as a frame of reference as we go through a couple of these other areas, because next up was discretionary. And discretionary, after taking a big hit, it moved into positive territory, moved to the high of the day, and then weakened a little bit into the close. But overall, I thought the XLY handled this news very well. And energy, also strong. From 2 o'clock, initial move was down, then we rallied, came back down and finished just about where we were at the start, maybe down just fractionally, but we did outperform the S&P 500 in energy over those final 2 hours. Now, the areas where we were really weak and things were not so good, we can start off with real estate. Real estate really just fell out of bed. Once this news hit, you can see real estate, and once again, you're thinking, okay, inflation, real estate shouldn't be getting hit like this if inflation's a problem. I don't think it was the inflation part that was scaring folks out of real estate. I think it was the fact that the Fed just said they were going to move up the timetable for raising rates. That's going to have an impact on anybody who is an income investor might start to consider treasuries if treasuries are making a move back to the upside, and avoid some of the dividend payers, some of the key dividend payers like real estate and utilities, which also, let me show you utilities. That was a pretty big drop, a little bit of a rebound, and then another drop into the close. And we finished almost on low of the day in the real estate area. And if you look at utilities, very similar, except not very much bounce. So selling, a little bit of a bounce, and then right back down near the low of the day at the close. So you can see both of those groups not very good. Here is consumer staples. So you saw utilities going up. Staples went down, had one little pop, and then went back down near the low of the day at the close. And then the last group, XLV, this is the next worst group. Selling, little rally, and then weakness into the close. Think about this though for a second. After the 2 o'clock announcement, the 4 sectors that performed the worst in the final 2 hours: real estate, utilities, consumer staples, healthcare. Those are the defensive groups, the 4 defensive groups. That's why I believe the market is not considering inflation and is looking still at a very strong economy where inflation is not going to be a problem. It is going to be transitory. That's the reaction I'm getting from the market. Now, whether or not that continues, well, we have to watch the market. But that initial 2-hour reaction I thought was very telling this afternoon. At least gives us something to work with in the very near term, which is don't go with the inflation plays. Now, maybe that changes tomorrow. Like I said, we'll continue to watch it, but I would continue to be thinking growth story. Let's watch that IWF IWD. It did finish down from 2 o'clock, so that one did go down a little bit, but we did see a lot of rally. And we also have to consider that right in the middle of all this, we've got options expiring on Friday. So how much of the bounce at the end of the day was options related in some of those growth areas that maybe had been hit recently? Very difficult to try to put all this together and then figure out exactly how all the pieces fit together. But we can at least work off of some of the initial reaction, and that's what I was trying to do this afternoon. Now, as far as the industry groups, one group in the financial space that did not do well, it was the worst performing industry group out of all of them, and it really got hit in the last 20 minutes of the day, was the insurance brokers group. And it was down, it rallied, and then really took a beating into the close. Another one that we saw was the diversified REITs. So there were a lot of real estate related industry groups down at the bottom, but you can see the diversified REITs actually took out that initial low and closed down near the low of the day. So really weak finish there. And then water, I mentioned utilities didn't do well. Here's the water index, pretty much just selling. And when you think of utilities, water companies, I'm thinking dividend payers. So yields are going up, 10-year treasury. That could influence a lot of income investors away from utilities, away from real estate, away from staples, some of these dividend payers, and into perhaps some of the treasuries. Let's see. Next up, we had the industrial and office REITs. Again, another REIT area, very, very weak in the final 2 hours. Another REIT area is the retail REITs. Down, nice little bounce back, almost even, right about the even, and then very weak finish in the last 30, 40 minutes. Now, here's one that I think is very, very telling. Don't know if you saw this. Look at the reaction in gold mining stocks when that news came out. Again, this is an area that should do very well in an inflationary environment. So the Fed talks about, they recognize the inflation. They're stepping up their rate increase from 2024 to 2023, and gold promptly sells off. If you look at gold itself, the GLD, look at this weak 2-hour finish. And look at the volume pouring in. Everybody getting out of gold. Gold is a hedge against inflation. This is where you would buy if you were really concerned about inflation. So again, what is this telling us? Initially, it's telling us the market does not believe inflation is a problem. All right, I'm going to move on. Let's move on to earnings spotlight, and then we'll wrap up with the 3 you must see. Not a whole lot out in earnings. I do want to just point out Lennar. Lennar came out, and we'll look at a relative chart. Let's stretch this chart out. So this is a 1-year chart, and Lennar, relative to its peers, you can see has really been struggling the last 3 months. Overall group, home builders have rolled over in the past 5-6 weeks from a high now to about a 3-month low, absolute low. And then when you look at the relative strength, home builders are nearing this low back in February, which is almost the low in 2021. So definitely home construction has been weak of late, and Lennar has been weak relative to its group. So you've got a weak stock within a weakening group, and that usually doesn't bode well. The stock came out, they did beat 295 versus 234, but the reaction after hours was very muted last time I looked. And let's see if we can get that latest quote here. So yeah, I mean, it's up 31 cents in after hours. So it beats by a mile and gets almost no reaction. So until we can get back through, and I'm going to take you back over to this chart, till we can get back through that 20-day moving average, I would be very careful with these home construction stocks, home builders. And one thing that I would be looking at to the downside, I see two levels of support that I would be watching. The first one, you see this huge volume? Stock opened up at about $88 and then ran all the way to 100. That was on massive volume. When we come back down, as we get close to 88, I would expect to see some support there. Next up is the double bottom that we saw down at 80. So these are the two key areas. And right now we're just, we're seeing rotation. And I think we're going to continue to see this rotation away from the home builders. All right, let's move on to the last segment for today, which is the 3 you must see. And I'm going to start off with Sirius, or XM Sirius. And that is because we had a big move back here over the last 6 days. I remember talking about Sirius about a week ago on this breakout, talking about how big and how impressive this breakout was. We were a little bit overbought, and we have now pulled back. We got up to about 730 or so, and we've pulled back. Today's low was 646, about a 10% sell-off from the recent high to today's low. And with this stock starting to show strength and volume trends picking up, I think this 20-day moving average holds. So I just wanted to point out, when you get a stock that is making a move like this on nice volume, breaking out above prior highs, sometimes you don't always hold the breakout level. And this was something that I added into my trading arsenal, I don't know, several years ago. I used to only trade breakouts and hold breakouts if they held their breakout level. So a close back below 680 and I would have been out of Sirius and probably wouldn't have looked at it again for a while. But in this case, and now I've actually seen so many of my stocks that went back, lost price support, and then bounced off the 20 and then turned back up and went higher again. So now it's the combination of price support, that's 680 area, 685, and also the 20-day moving average. I'd be looking at both. Next up, FHI. This is Federated Hermes. Anyway, we got a big breakout, nice volume, taking out the prior high. AD line's been rising. I think this looks good. It's in that asset manager group that I just said reacted so positively today. Here's a leader. This is a stock that's starting to show nice relative strength right here versus its group. So keep an eye on that. And the last one I have for you is MBIO, which is Mustang Bio. This is a stock that moved up. Bios have pulled back in the last week. This stock was over $4. It went down today as low as $3.35, held on to its 20-day moving average. I think it could rebound from here. That's it for me today. I appreciate everybody tuning in. I'll continue to watch that inflation reaction and the Fed announcement reaction. We'll talk about it some more next week. Monday will be your next Trading Places Live. That will be at 9 o'clock Eastern over at earningsbeats.com. Hope to see you there. Enjoy the rest of your week. Have a great weekend. Take care, everybody. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.